This is Oliver, and I'm excited to bring to you today the professional case studies. Today we're going to talk about a draw on liquidity, specifically for a small range week framework. So let's get into price theory. So what are the requirements for trading the small range week framework? First of all, we need the small week range itself, then the daily range valuation of that, which is the 25%, 50%, and 75% of this. And then the PD arrays within that daily range, which gives us the exact point of interest we're interested in. So mainly that will be liquidity and fair value gaps, but also due to the small range week, rejection blocks and wick CEs will be utilized a lot as well. So we want to layer these with the valuation here, and we want to trade within the small week range. Okay, that's the base, that's the outlook we're in. So small week range, in this one it's an inside bar. So you have an inside bar week here, so it's a week here, close inside, close one more time here, tap the extreme, and now we're ready to expand. But all of these weeks here have been small ranged weeks, which means price will not be expanding outside of the inside bar week here. And this normally occurs between higher time frame inefficiencies for fair value. Okay, so when price doesn't want to trend, it will just trade between two. Let's say this is a price range. This will be a fair value gap here, and this will be a fair value gap here. It will just bounce in between like this for fair value, because a fair value gap is an area of fair value. So once we have our range, and we know that price is going to be consolidating within that, we want to mark out the daily range valuation now. And price will respect the valuation of the range, extreme premium here 75% to 1, or extreme discount 25% to 0. Price will gravitate to and through the equilibrium here to seek these areas. So it will go to and through the equilibrium, extreme premium, to and through the equilibrium, extreme discount, to and through the equilibrium, extreme premium. Alright, and then we'll keep doing this back and forth until certain PD arrays will get exhausted, which we'll get into a bit. But that is already a short-term draw on liquidity, or like for bias, when it comes to inside the range, where if we're below the equilibrium now, we reacted off a premium here, then it would want to seek some sort of discount below the market. So you have here, 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 but why this one specifically? Well, because it's the extreme discount here. Then, when price has met a discount objective, it will first gravitate towards the equilibrium here. Then, once it closes above the equilibrium, now it would want to seek a premium. So we have a premium fair value gap here, and then the premium buy side liquidity here. Why this one? Because it matches the extreme premium here again. Then it reverses. Why does it reverse? Because this is how a consolidation happens, okay? Warning sign. So there is a tendency for price to become lethargic near the equilibrium. So just pay attention that when you're near here, price will become a little bit more choppy. But if you're at the extremes, that's when like reversals occur, and that's where you want to be framing most of your trade setups around, or waiting for the volatility valuation here and then trading after that. Now let's get into the PD arrays. So focus mainly on liquidity and inefficiencies within the range. And a valid point of interest which is the PD raise, should overlap with the valuation of the daily range. So we have the small week range here, then we have the valuation within it. Then when we select our PD raise, we want to make sure that it overlaps with these valuations here. So you have the previous week's inefficiency here. We can see how price uses this for a move to here, mainly because it's at the extreme premium matched with PDA ratio. Then it seeks previous week's low here, and also this old exhaustion gap here from the inside bar week here. So notice how price seeks the extreme discount here, and then that's the reason why this liquidity pool is key here. Why not this one? Why not this one? Well, because it has an objective. This is the main objective of the inside bar week here, and I'll keep doing that back and forth until it becomes exhausted, which should be in the next slide, or it will come up soon. So use Fulcrum swings within the range to anticipate potential total soups. Okay, so when you're anticipating a total soup, like below this low here and then a reversal, you want to make sure, okay, that leg here that's going to create the swing, because this is a failure swing, okay, does that match with any Fulcrum swing here that could cause a reversal? Okay, and where the reversals will most likely happen is at the 1 standard deviation. Okay, and just incorporate these as well for the wicks. But that should be a valid total soup if it matches with a liquidity pool, especially if it's a key liquidity pool, also match with valuation here. Okay, we can see the same thing here. Now this one aims for 3, but the liquidity itself is way past the 1, so you would use the most near term. In this case, it will be 3, and even 3 Fulcrum swing from this point here, that is overextended. Okay, so what an overextended move can cause is it can cause a move, overextended run, and then reversal because it can't sustain it, or it could cause a move and then a consolidation like this, right? So it's either move, reversal, or move, consolidation, okay, which we'll get into a bit. And lastly, just want to point out that watch out for wick CEs and rejection blocks instead of liquidity. Alright, so whenever price is going to take out liquidity pool like this, if you're watching like EU or GU at the same time and it doesn't take out the high, it's most likely because it's using a rejection block or wick CE instead. So what would that look like? If we see like this swing low, you can see how it holds the wick CE here, and it doesn't take out the low. Now, price will reclaim PD raise within the range until exhaustion. So, after the PD raise at the extremes have been exhausted with the second test, anticipate the range high and range low to become tested next. So, when you have the daily range of the inside bar week in this case, and then the valuation, and then you have your PD arrays here now, there's a tendency for these small weak ranges to reclaim these PD arrays multiple times. So the magic number is 2 times. Okay, so you can see here we have 1, 2 move. Okay, or this one is 1, 2 break. Right? So a PD rate can be tested 2 times, And on the third time, that's when it breaks. So if we can see, even with this here, you have 1, 2, even though this leg holds, in the future, when it comes tested on the third time, it breaks eventually. Okay, and it becomes no use. It's become exhausted. This one, 1, 2, on the third one, we can expect a break. Okay. It became short-term resistance, but the narrative said, okay, this is not going to go lower, so it flips it as support here. Okay, so this is just nested. For the proper refinement, though, you would use this order block here with the extreme discount. So there's many ways to do it. I prefer this because it's fresh order flow, but I'd also look back here and then say, oh, that's nested with an old area of order flow, so it's supported in terms of like structure and the amount of PDRAs holding it. And after the PDRAs at the extremes now have been tested multiple times, we anticipate the range high and low of the inside bar week now to be tested. Right, so you can see here 1, 2, 1, 2, exhausted. Now test the actual range low and range high. And then after this, that's when you would expect price to be released from this inside bar week. So here is when price should be released from this inside bar week, and we should be expecting some trend. And that also played a big role on euro, because euro is the weaker pair right now, so shorts on euro would have been way more expensive here. And even though it's a small weak range framework, it wasn't that much small range weak for euro due to it being very weak. But we still treat it the same due to we don't know when price is going to break out convincingly out of this inside bar week yet. Okay, so it only just showed signs of breaking the absolute high here. So we're going to see how it wants to react at this valid gap here and at this mitigation block here. Okay, it should not want to lose these levels here. It should want to hold them and then enter some sort of spooling price higher. Okay, especially after this displacement and monthly open. But I digress. Let's get into time theory. Time theory impacts the small range week. Sorry, let's do that again. Time theory impacts the small range intra week, so inside of the small range week, with accumulation, manipulation, expansion. Okay, so time theory influences this inside of the candlestick with consolidations, reversal, expansion. Just AMD, okay? So, it starts with accumulation. Unless the previous week has already done some sort of accumulation, then that would be considered. But if there hasn't been, or maybe it's just a consolidation type narrative where it does a lot of consolidations, then we always start with a consolidation. Consolidation starts with frameworks. Then we anticipate some sort of manipulation on that consolidation, and then reverse on that for an expansion towards the draw on liquidity. Okay, so where are we going with all this? Well, we need to know this because draw on liquidity is based on time theory as well. You're only going to get the valid draw on liquidity if you know how to identify when the week is going to expand. Because you could be looking for the wrong draw on liquidity and you could be falling victim to the manipulation, or you could be mistiming the week altogether and being stuck within a consolidation. So therefore, if you want a valid draw on liquidity, you must be able to time the week also, which is why trading is so hard to teach otherwise. there's so many things that interconnect. So anyways, we start with intra-week consolidations, which is the accumulation. And I'll get into why it accumulated. But first of all, let's notice how price uses the new week opening gap. So the current new week opening gap, that's the most fair value price for the week. Okay? So the current week, the new week opening gap, that's the most fair value price if we think about a market maker, right? Notice how they use the CE of that and the range high to just distort price in between. And what does it does just fair value, right? So it's bouncing in between 2 points right here, just forming a point of fair value. Why does it do this? Because you have to be a long-term thinker here, and you have to anticipate, okay, there's going to be a displacement later in the week. What's it going to do then? Well, if it's already moved from an expansion, then it might go into consolidation, especially if it's before key news, which we'll go into a bit. But if it was not to consolidate, the other thing it could have done was market protraction. So it could have just done like a protraction like that, and then sweep everyone out, then reverse. But in this case, it did a very nice, beautiful tight consolidation, mainly influenced by the inside bar week as well. So a little bit more into the consolidation. So price levels may still be active and valid, but not move due to time distortion. So what do I mean by this? You could have the exact right levels marked out, but if the timing aspect for the week is not there yet, then price is not going to move, and that could cause you to self-eject from the price level itself when you would have the best price level as well. So this is why time theory is most important component of IPTA. It provides the volatility aspect for price to move. And notice how this week price has to wait for CPI and FOMC before being able to expand. So notice how here the most important news events for the week was basically CPI and FOMC. So the days that trade before that, smart money is normally waiting and saying they're not going to be doing anything beforehand. But also a retail trader, some of them are professional and they won't trade before that as well. Maybe they want to wait for these high volatility days as well. So what you got to do is just got to wait for that as well. Just got to be patient and wait for the retail trader to see this and do something about it, and then you do something about that from the eyes of a interbank trader, which can see both retail-minded view and a smart money view. So hopefully you caught that. And we just had consolidation, even though we had the price levels were valid, which was Monday's high and then order block here. But just notice how it's lethargic and then random move at the 25% of the week, by the way. And then displacement, then another time distortion, then moves, then single candle, bam. It just goes to show that it was waiting for the volatility for Wednesday, but the levels, they're still right. So what you could do is you could just be comfortable with holding through that time distortion by trusting market structure. So that's why I have an order block here. As you can see here, we have order block, order block, order block, order block, and just look at the low highs. Okay, that's one. And another one is taking out Monday's high here and then gapping away from it and breaking this down candle and breaking these nested areas here. And I'm sure if we could go one more time here, if it gaps lower, that would have been a nice opportunity, but I digress. This is getting too extended. And oops. Now let's get into the intra-week reversals. So this is what you expect to happen after the accumulation or consolidation. So after key PDRA is active, an intra-week reversal will occur due to the nature of the small week range. So intra-week reversals tend to happen more often in consolidations because price is not trying to get from A to B. It's trying to stay stuck within A and B, if that makes sense, right? It's trying to stay stuck within it, whereas the trend is trying to move away from it. Okay? So how price will stay stuck within here will create reversals like here, 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 here. So by creating intra-week reversals, this maintains the small week range like so. But if it was a trend, okay, then it will create like high. Then once it trades through to the low, it goes to and through it. It range expands through it. It doesn't reverse and create a small range. It goes to and through it. So from A to B, to and through it. And we could anticipate the reversals to occur at or close proximity to the midpoint of the week. So we can see here, midpoint of the week. So Friday close, Monday's open. That's what I like to use. This is where you can anticipate a midweek reversal. And you can see it doesn't happen exactly at it, but just a close proximity. So if we refine it to the days, we can say, okay, that's the late day of Wednesday, where it does the Judas, and then it does the change in the state of delivery in the late day of Wednesday. So Wednesday, late day low of the week, and yeah, it's just nice to see where the change in state delivery happens for intra-week reversal at the midpoint of the week. And then after the midweek reversal, we expect intra-week expansions. Now, this is when we start framing out the draws on liquidity, okay? So the weekly open will be the first draw on liquidity. Okay, so after, creating the low of the week, and the weekly power 3 candles trying to trick traders on the wrong side of the market before reversing on them, right? That's how they play the game. That's how they make losers. And that's how they become winners of the game. So when we want to anticipate that to happen is during the intra-week expansions. This is when they want to neutralize the liquidity that was engineered for the week. Okay? So now is when we want to mark out and plan out the draw on liquidity step by step. And the first one is the weekly open. Okay, so we already created the Judas swing for the week below it. So the first draw is back to the open. All right? You could say fill in this void. I would say that's more of a warning sign, because I would say, is it going to hit that level and then trade lower from there? Okay? But from a weekly candle, algorithmic perspective, I would say that the first draw for the weekly range, if this is wanting to reverse, is to the weekly open, and then we want to see it kind of go to and through that weekly open. And especially in a small week range, by the way, especially in the small week range, by the way. Price would do the intra-week reversals and then straight away seek back to fair value at the weekly open, since that is fair value for the week. That is the most fair value point for the week. Okay, so after an intra-week reversal, that tends to be the first draw algorithmically. Now, after the weekly open's been sought after, and maybe there's still enough time in the week, okay. Now, if we start to close above the weekly open, the next show on liquidity is the actual intra-week high. So, what is the actual intra-week high? So this is where everyone for the week is currently pending their liquidity. And intra-week expansions, like I said, it tends to aim for that intra-week liquidity pool for like a completed transaction, right? From counterparty A to counterparty B here. So if we manage the weekly open, that's more of a low-hanging fruit objective. But the intermediate term objective now is the actual inter-week high. It's intermediate term draw because it doesn't have to go there. But most likely it will, but sometimes it won't. So you just got to be sure of that. And sometimes it's best just to take the low-hanging fruit objective, especially in a consolidation narrative where there's not enough, or there tends to not be enough, or a lot of volatility. But yeah, after the weekly open is the intra-week high, and that's basically targeting who is currently profitable for the week. So if we see here, the week so far, everyone was short. We have the intra-week reversal, where they're going to reverse. Okay, that's going to take out everyone who was profitable for the week so far here. And that's a nice, beautiful market maker buy model. And then, after intra-week high gets hunted, the next draw liquidity is a long-term draw liquidity. And this is when you want to have price open float above the intra-week high. So if we look at a weekly candlestick, if we have a large range week, we have the open, low, high, close. When price goes back above the opening price here, all of this body is open float. Meaning that the open to Judah swing here, the manipulation here, let's say if you owned trillions of dollars and you put 1 trillion here as risk, wouldn't you want to make at least 2R back of your trillions? So you have 1 trillion, now you have 2 trillion. The same thing about open floating. So if you had the open and you manipulated price below, you would want some return on that manipulation, at least 2x. That is basically the open floating above the open. But the problem is with a small range week, though, you're not anticipating a large range week. You're anticipating more of a small range week. So therefore, if the narrative is consolidation, don't aim for overextended Fulcrum projection. Meaning, if this is the intra-week high, you don't aim for the next level above 2. This is the close proximity one. Here, you're not aiming for 3 or 4. That is something you'd aim for, or even 5. That's something you'd aim for in a trending market. But this is consolidation. So it would take out the high and then snap back within. So you want to respect that. And you don't want to try force your will onto the market when it demands you to be trading with a more consolidation type style. Okay? So just be careful of that. And we can see we have 30 pip sweep above the high. and the Fulcrum swing projection overlaps right about the high here, and that's where we close the week beautifully. So let's get into some intermarket theory. And lastly, there are 3 niches you need to observe to follow smart money displacements. Okay? You need to know, this is for the Forex niche, by the way. Okay, so for the Forex money flow, you need, there's, in the Forex ecosystem, there's dollar, majors, and like cross pairs and exotics. Okay? Dollar is the most important, so it's the parent. Okay? Why? It will govern money flow for the subordinate markets. So if dollar goes higher, this goes lower. If dollars go lower, this goes higher. So dollar governs everything. Subordinate will follow the tide of the market. So if dollar goes higher, this goes lower. If dollar goes lower, this goes higher. Okay? And we'll get into this one in a bit as well. But just know that these two are subordinate to the parent, and the parent will determine these two right here. So how does a crosspair or exotic come into the equation then? Well, assuming that the dollar is undergoing small range weak framework, right? Which means consolidation, right? So the dollar is consolidating. The parent will govern the money flow of these two markets here. So if there is a small range weak framework, this means there's a lack of smart money activity on the lower time frames. So price is just trying to stay stuck here. So how would that affect the majors? Well, the subordinate will follow the parent here, mostly because it's connected, but also since there's a dollar included in the majors. So it would be like EU, GEU, AU, right? You can see there's US dollar inside it. So if there's dollar in it and the parent says I'm in a holding pattern, this means the majors is also in a holding pattern. The difference for like cross pairs and exotics now is they don't include the USD in their ticker. This would look like Euro, GBP, or GBP, AUD. There's no USD in the ticker. So it will still, since this is the most important market, it will still govern this market right here, but not in the sense of like the majors because it has a US dollar attached to it. This will be influenced by the dollar in a different way. So it will still follow the tide of the parent market. So whatever the dollar is doing, it will follow. But it will do the opposite profile. So if the parent market's in a consolidation, cross pairs and exotics does the opposite profile, which means that it will do a trending profile. If the dollar index is not in a trending profile, however, then cross pairs and exotics will do the opposite profile as well, and they will go into a holding profile. Okay, so the parent will still determine this subordinate sector, but it will just do the opposite profile because it doesn't include the US dollar. As for this one here, if the dollar is in a trend, then majors are in trend. If the dollar is in a consolidation, then majors are in a consolidation. So here's the dollar index. You can see 1, 2, 3, 4, 5 weeks, basically just consolidating. And dollar is in a consolidation due to the quarterly profile being a consolidation. So just go study the Q2 of 2024, and then you'll see why there's been small range weeks. It's due to the quarterly profile. And you can see here, due to the parent dollar being in consolidation, you can see euro also being in the consolidation. And pound here is a little different. Okay, so it's still in a consolidation, but pound is in a consolidation due to the dollar, but pound is currently the stronger pair. Okay, so instead of holding stock in between highs, you can see that due to pound being stronger, it will just run highs, but just in a lethargic way, where it's not really trying to expand, but there's just bullish momentum and bullish pressure. So it's still lethargic because of the consolidation, but it's lethargically running highs. Okay? And, well, this, we can see this is pure strength, and this is not as strong here. So that will become a factor in selecting the cross pair later on. And here we have Aussie dollar USD consolidating. You can see how it's staying stuck within the inside bar range here, not running highs, and just staying stuck range bound for a while. And we can see here NZD USD is clearly stronger because it's breaking, that should be red, it's breaking the highs here. Okay, and still in a consolidation type pattern, you can see consolidations love to hold the rejection block and wick CEs here. Okay, so just be mindful of that. And now we can see this is stronger than this one. Okay, because this can run its highs whilst consolidating, whilst the dollar is consolidating as well, and this can't. So now we can start to match the pairs, and this is just intermarket analysis. It helps to know because this is the best price action to be trading in. So if you can identify this type of price action, the way you take action in these market conditions is different to consolidating market condition, right? Here, your bias has to change back and forth, back and forth, back and forth, once or twice a week or 3 times a week, right? It's not the same every week. This, however, is the same every week, so it's nicer, and it's a different trading style and mindset. So Euro GBP is subordinate to the dollar index. Why? Because the dollar index is the king currency, right? However, they have an inverse relationship for market profiles. So you don't see dollar index in here, but the relationship they have is through market profiles. That being is if dollar is in a trend, euro pound will be consolidating. If euro pound is trending, dollar will be consolidating. So you want to be placing most important on figuring out, okay, what is the profile for the dollar going to be, since that's the most important. And then if you can figure that out, you will have the answer for euro pound by just understanding that algorithmic relationship. And if dollar index is in a consolidation, we can anticipate euro pound a trend. So that's just the relationship, right? And vice versa. And here we see Aussie dollar weaker and New Zealand dollar stronger. And that manifested for weaker prices in AUD, NZD. So we can see the majors are consolidating and the cross pairs are trending. So, draw and liquidity. So what is the draw and liquidity? So we just want to pick simple draws liquidities of key liquidity pools and inefficiencies identified with time theory. So what does that mean? So first of all, the current week, we'll get into that in a bit. So IPTA will refer to PD rates that are within its data range. Okay, so what is a data range? It's a range of data that IPTA will refer to. So if we're trying to navigate the intra-week, refer to the previous 3 weeks of data from the current. So this is the current week. And then this is 1 week look back, 2 week look back, 3 week look back. And then the IPTA from the current will use the 3 week look back for PD arrays. So we can see here we have high, high rated. Then we have fair value gap, balanced price range here. Then we have a high probability displacement, optimal trade entry into this imbalance here, and then another displacement lower. So we can choose this imbalance based on 1 week look back, and then we can trust this high based on the second week look back and third week look back. So now we're just reading the data within the data range. Okay, but also within the point I was going to make was that within the current week, you'll also have time theory, which comes from the economic calendar. Okay, so that's one more thing to point out. But we're talking specifically about the drawn liquidity here, okay? So, yeah. Notice how the week respects the prior inside bar week dealing range EQ. So we were talking about how price was stuck in the inside bar week range and then was ready to expand into potentially large range weeks to come. And just notice how that final week that was ready to break it out of the inside bar week range, notice how it returns to the equilibrium one more time to say, okay, we're done with this range now, and then displaces out of the equilibrium price. So it just looks very algorithmic, if I would say. So what is key? What is drawn liquidity again? And all of this here, we could just refine that on the 1 hour. So the 1 hour is best to refine PD rates on the 1 week. But we have here is basically the data range last week, daily fair value gap here. So we know it's key because it's found in late week as well. And I've just divided that daily fair value gap into quadrants of 75, CE, and 25. Normally, we don't want to see the 75 get hit. It can though, but it needs to have a strong rejection away from it fast, which is what happened here. So that's beautiful, and that forms some sort of breakaway gap. And notice how that beautifully overlapped with the previous new week opening gap here as well. Alright, so that's why the data range is beautiful, because it will remember the look back it's referring to. So when do we anticipate the drawn liquidity? So IBDA will seek the drawn liquidity during the range expansion part of the weekly Power 3 narrative. Okay, so you can see here, earlier week, we start off with a consolidation. It does so at fair value. And then induces shorts in the market. They're going to put the stops above here. So what does the market do? It forms the Judas swing, takes them all out, creates new pending liquidity here. Then now range expansion part of the week seeks the engineer liquidity for the week below the weekly open as well. So the weekly Power 3 narrative will refer to time theory, then price theory for the weekly profile. Okay, so just make sure that you notice what key time events are happening within the week, such as CPI or FOMC, because time theory, that will have a huge influence on when volatility will come in, and you could have the right price theory levels, but you could get swayed if price is not moving at your price levels if you're not aware to what's happening due to time. So just remember that, okay, when it comes to when to expect draws and liquidity to be sought after for the week, it's most likely going to happen during the range of expansion for the week, because that's what it's intended for. So where's the draw and liquidity? So when it comes time to draw liquidity now, we want to just create a short-term draw liquidity, an intermediate-term draw liquidity, and a long-term draw liquidity. Okay, and we want to create these targets based on weekly power 3 range expansion. So remember that open, low, and expansion. Well, open, low, when it comes to the expansion part, that is when we want to frame our short-term target, our intermediate-term target, and a long-term target. It's during the range expansion of the week. Okay? So not only do we know, okay, we need a frame of draw liquidity during the range expansion part of the week, we also know now that, okay, that draw liquidity can be broken down into 3 draws on liquidity, one being a short-term, intermediate term, and a long-term. Okay? So after the anchor point formation of the week, okay, so that's when it goes from manipulation to range expansion. And the short-term order flow, okay, so that's intra-week. The short-term order flow will go from consolidation, manipulation, Judas swing, range expansion, right? The short-term order flow is constantly adjusting and changing, right? But we want to focus on when this changes from manipulation to range expansion. That's when we want to start framing the draws on liquidity. And the first draw on liquidity is the weekly open. So this is the change of state delivery now. Right here. So the first draw on liquidity is a short-term draw on liquidity. It's the actual open. Then the intermediate term draw on liquidity is the intra-week low. And then after intra-week low is an open float projection, which is what we have here. Okay, and notice this was a pretty large range. But that was mostly because this moment here, price was ready to transition from a consolidation to an expansion holistically, right? Holistically speaking. So it's ready to move already. So yeah, once again, just use the Falcon swing projections as projections for valid swings, right? So similar to how I use this intra-week, so this inducement for the manipulation, notice how the manipulation can also be projected using a fulcrum. And that gave us a warning sign. And then the actual range expansion part here, we could create a projection for that as well. How far can the range expansion go to and through the intra-week low? We have this high and this low. And why we wouldn't use this range here is because this one's too large and it's most likely not for the week. It's more for the month, or it's just something too large to consider for a small range week framework. So you would use this here. And then you would find the Falcon swing here. And the 2 would be great, but this is the weekly pair, so the weekly pair can become more extended, and you can see how price reaches the overextended levels here. So, summary. If you are going to trade during small range week framework, trade major pairs with a small range mindset and framework. Okay? So, create a small range framework strategy using the topics we discussed today. So, understand the objects discussed, small range week, dealing range valuation, the POIs, the Falcon swings, the mindsets, the relationships, everything we talked about here, and their systematic relationships. Just form a strategy with that, and then just back test it over and over again, forward test it, and then learn, adapt, and go with it. And if you need my help, just message me. And if you don't have a small range strategy, and you're not really interested in making one, well, there's gonna be, I would say it's best to make one. But if you just don't have one, so step one is if you don't want to make one, but you still want to trade, step one, study the relative strength of the major currencies. Okay, and this is assuming that the dollar index is in a consolidation, so that the cross pairs move, right? So step one is you want to study the relative strength of the major currencies. Then you want to select the prime cross pair with the strength and weakness analysis. So that could be like the euro pound, or long short, or GBP AUD, or AUD NZD, and you're just pairing it up. And then since that pair it's going to be trending due to the majors being in a consolidation, only then is when you can trade the exotic or cross pairs with a large range strategy. Okay, and that's if you don't have a small range strategy to trade the majors with during a time of consolidation. And lastly, note, you are still going to need to know how to anticipate a small range week, even if you don't have a small range strategy. So don't force large range week strategy on small range weeks, because it doesn't fit, all right? And it's not following smart money. So that's why you're still going to need to know how to anticipate a small range week. And if you don't have a small range strategy, then just trade another market that will have large ranges. And you just got to identify where the money flow of smart money is going, and you just got to follow it. So it's following rather than adapting. But yeah, don't try and skip it, otherwise you are trading with no narrative. And just lastly, warning signs for trading small range week framework. So time is intra-week consolidations. Just be aware of this, because in small range weeks there will be extended consolidations. So you just don't want to be forcing anything in a market that's not going to move. And also intra-week there'll be reversals happening. So you don't want to stick to one side of the market and marry that side of the market, because there's going to be a lot of reversals in a small range week. When it comes to price, there's going to be a lot of lethargic price action at the equilibrium. And also PD arrays will be reclaimed once and twice. So just be mindful of that and use it as a warning sign, but also for a potential setup. And lastly, for intermarket, if you are trading the majors in a small range week for the dollar, just know that if you're trading in the weekly pair, and it's not going to move, right? And it's going to stay stuck. So it's best to stay really strict in those situations and stay very nimble. So this has been Joel on liquidity small range week framework. Hopefully you enjoyed, and I'll catch you in the next video. See ya.